Any deals? Thank you, Sheena.
Hey.
Dante.
Yeah, hey. Hi, it's Auntie
Oh, hi,
Bo.
Tammy.
Hi, how are you? Hey,
Good,
I just
good.
have a question for you guys. Do you know anything about Hawaiian homelands leases or anything?
Yeah, we've been talking about that in the office. Unfortunately, to my knowledge, there's nothing we can do with those properties. It's very unfortunate, to be honest. And to me, I guess it's proving what happens when you basically give a house away for free, because who's going to fix that up now, right? Because real estate investors can't go and buy those properties, unfortunately, because there's no exit for us. The land is, owned by Bishop Estate, right? I believe.
Here on Maui, actually, I'm looking at the pineapple plantation up country, and
Okay.
I'm kind of looking at it, not even with a house on it or nothing. It's just an old pineapple field. I don't even need a water source for my little adventure. So I just was wondering if you guys knew anything about it. It's pineapple and pine is what it is. But I'm going to run up there today and check it out and just talk to him about it, because my best friend is an animal control officer, and she actually can own Hawaiian lands. So I was going to have her maybe do an adventure with me into it. And then I have to find zoning and everything else. But it just kind of came across my plate, and I just thought I'd ask you guys if you knew anything about it.
I actually don't. I just know my experience with if it's a single family residential
Right.
that's on Hawaii,
Right.
Hawaiian homeland. But does anybody else know or have an answer for Tammy?
That's okay. I just, what a better place to talk. Hey, and I want to thank you last week for talking about your first experience when you started in investing, how you didn't know about like just everything that you had said about, I didn't know this and I didn't know that. It's like, wow. Just
Yeah.
that made me feel really comfortable. And I know I've talked to you about oddball things before. It always seems to be what I come up with. But I just wanted to, reach out and just, ask you about this and say thank you, because I appreciate what your experience and your knowledge so much.
Well, I'm super excited for today because honestly, I learned from Rocky, who's on the call. He's our guest today, and I've learned so much just from his YouTube channel. So, but we'll get it. We'll bring Rocky on, and I think it's gonna open a lot of eyes for everybody about the private lending industry. If there's someone to talk to about it, it's Rocky, because he's the ultimate connector, right? We talk about being connectors. He's the ultimate connector.
Right.
So,
all right. Well, thank you. Perfect.
Yeah. Anybody else have anything? Deals on the line that they need funding? Dante.
Hey, Corey, I got a need.
Okay.
I need a realtor investor, like a investor's realtor. I need one in New York.
New York. Okay.
Yeah.
Hold on. Ooh, New York.
Yeah.
I might know one guy. I
Yeah.
might know one guy, and I don't even know if he's the right guy, to be honest. So, does anybody know?
Do you have a specific area? I do know a couple of investors there. I'm sure they'll share their contacts, but
it's
New York is huge.
SCIO New York. SCIO or something like that. SCIO.
Where is that?
I know. FCIO New York.
No, S.
Yeah.
Try spell them in the chat if you can. Not there. You're cutting out, Dante. Dante?
In the can you hear me? Hello?
Yeah, you're cutting out, bro.
I reset this battle.
Okay.
But
Also go back.
in the group chat. I texted in the group chat.
Okay, thanks. Well, we'll circle back to that too. All right. Oh, I was gonna ask you a question. Are you in Vegas still?
Yeah.
Okay.
The buffet.
Yeah.
Time.
He's
A
at the
buffet. Which buffet?
California.
Oh,
Yeah, the one in California, because
he's too busy eating.
I think we lost you. Okay. All right. Does anybody else have
Sorry, he
anything?
got cut off.
Yeah, guys, next week, Tuesday, we're having our monthly Deals and Aloha. We're featuring Alex Camacho and Will Wall, their project out Pokai Bay side. It's going to be a good one. 11 to 1. You can look at our Instagram, right? There's my handle. The flyer's up there, but everybody is invited, no experience needed. It's a good place to leverage resources, find contractors. Like, there's people at all different levels. So please come out. They're gonna hold this property. So all the other deals in Aloha's we've done, pretty much all of them have been surrounding the fix and flip space, but they're having a different exit plan on this one. So should be fun, guys. Would love to see you guys out there.
Awesome. Come on. Yeah, guys, if you can make it out, take them up on it. That's where the magic happens, is kind of face to face, right? And be able to cut deals face to face. So, Sheena, can you do, let's do Dante a solid, and can you just get John's info in the chat? Sounds like, thank you, John.
Will do.
Yeah, sounds like he might have someone for Dante too. So thank you, guys. This is what it's all about. All right. Okay. Happy Aloha Friday, everybody. I want to jump straight into bringing in our guest, because it's someone who Kiko and I and Alex and Layla have served with in the NPLA, and someone who I've learned to gain a lot of respect for and consider a friend of ours. And I'm genuinely curious, because I still don't know too much about your story, Rocky, that I want to see, how did you find your way into real estate? And then not just real estate, but more like kind of the technology side and private lending, because it's a niche market. So welcome to our call. This is kind of our ohana, our family. But can you tell us how did you, who you are, how'd you get started?
Sure. Yeah, thanks for having me. This is great. I'm really impressed with this whole thing and how you guys meet every week. This is wonderful. So yeah, thanks for having me. So a lot of people, when they see me, they ask me about my background and like, oh, were you a tech guy or were you real estate? And it's neither of them. I was always a marketing person. So I had, in my early 20s, I had a virtual tour business in the residential real estate space here in Silicon Valley, and then in my mid 20s, or let's say 2005, I started a business doing commercial real estate marketing. It was a for sale by owner service. I didn't want to be a broker, but it was more a service to get potential buyers for for commercial real estate owners without getting too involved in the transaction. So I did that for a few years and realized it was a failed business model. So I started looking for something else to get into that was in the real estate sector.
Okay, wait. How come it was a failed business model? Like, what was the main reason?
It was just the fundamental that commercial property owners, I thought, would be savvy enough to sell their own property. But in some cases it worked. In most cases, I realized that they really did need a broker representing them to figure out the valuation and just having that separation between the buyer and the seller. So
Gotcha.
So yeah, it took me a while to learn that. In theory, it was good. Most property owners were really excited about it because the idea is they would save a lot of money on the sale. But especially in commercial real estate, they are sophisticated transactions. So I realized they do need an expert in helping them throughout the whole process. So I still wanted to stay in the real estate space, but I didn't want something so hands-on. I wanted to just run a website. And the trouble was trying to figure out what to do in the real estate industry. And I read an article about private lending in a magazine back in 2009. Yeah, it was 2009 when, the article was no one's lending right now, but you might be able to get some money from private lenders, or they call them hard money
You
lenders.
still have that article?
I don't. No, I don't.
Oh, okay.
And I don't know if that magazine's still around anymore. But even back then, there was always this dilemma of, okay, is it called hard money lending? Is it called bridge lending? And in commercial real estate, they call it bridge lending. And then is it private lending? Is it hard money lending? I wasn't sure at the time, but I decided on private lending. But
I guess you chose right. Yeah.
I guess so. So I realized when I started researching private lending or hard money lending, there weren't any resources to find lenders. So I realized there was an opportunity there, and I thought, okay, if I'm going to build this website about private lending, it's kind of an untapped market. And I started off with about 10 lenders that I just reached out to.
Are they still with you today? Some of them? Or
a
no?
few of them are.
Yeah.
Nice. Some of them it didn't work out. But yeah, I still have some of those relationships.
Nice.
So that's how it started. And it took about 3 years before it really became a business and actually generated revenue. And that's really because I was running the old business throughout that time from 2010 to 2013. But really what it was is that it took 3 years for me to start ranking in Google searches. So
wow.
So that's how the business started to generate revenue and traffic, because it's just from Google search.
So it took you 3 years to and you built that organically, I'm assuming, right?
Correct.
Yeah. So,
yeah. So I built the first 2 versions of the site myself. I just kind of learned web development and SEO on my own. And I just, I built it myself. It was a big project for me, but I figured it out. I'm just not a programmer. I couldn't do anything sophisticated, but it was really, the more about the design and the content. And that's really what helped it generate revenue or traffic. And then
congratulations, because this business is definitely working, right? So,
yeah, thank you.
And Rocky, can you drop your contact information? Oh, Kelly, just thank you, Rob. But also your YouTube channel, please, because there's so much value in your channel, I feel, and not just for private lenders and smaller companies like ours who are new to the space and who are learning every day, drinking from the fire hose. You're able to articulate a very kind of complex ecosystem in layman's terms, so that like average day real estate investors like us can understand. So I appreciate that. And if you guys please check out Rocky's videos. It's very insightful. It'll show you how kind of like the money works, and if your lender's changing up guidelines at the last minute, they, it might not be a bait and switch. It might be like just circumstances that were outside of their control, so, but the more you understand, I feel, the money side, which is half of what we do, right? Finding deals and funding deals. And it's half of what we do. So shouldn't we allocate a lot of time trying to educate ourselves in how that side works? I feel it's necessary, right? So Rocky, now that you have been in the industry for so long, and you are in a position that we talk about being a connector, right? And that everyone in a sense has that opportunity to be a genuine go-giver and connector. And that's what we try to do every day in our business. And you're in a position where you're like the ultimate connector, right? You're connecting borrowers with the right capital, just using your technology and your software, your website that you developed. So what can you say about today's, or maybe give us a little bit of background from what you witnessed in how hard money has changed over time? Because I'm sure you were in the private lending space before, like a lot of the institutional capital started rolling in, before correspondent lenders came in and all that, right? So tell us about that, because that's before our time.
Yeah, so that really started in around 2015 when all the institutional capital came in the space. Before that, hard money rates were a lot higher. Where lenders would get their capital was either from individual investors or they'd have to just manage a fund and raise capital, which is a lot more difficult. But Those are the two primary methods that they'd get capital, and that's definitely limited. You didn't have lenders funding $1 billion a year or even a few $100 million per year until there was that institutional capital in the space. So that's really when it starts to change, and more from the last 5 years. And now that institutional capital is funding the majority of these deals. So it's been good for real estate investors because you've had cheaper capital, obviously with lower interest rates. And the other lenders that had existed before 2015 are still around. They haven't been able to grow maybe to the level they wanted to. Some are complacent with that. They're totally fine with the amount of business they get. They might have other loan programs that the institutional capital can't offer. So there's still a place for them. And what I've seen now in the last few months where the institutional capital has gotten a bit more expensive, those more traditional private or hard money lenders are seeing an uptick in their loan volume, or at least their loan requests. So that's kind of what the history is. You want me to keep going, Corey?
Yeah, well, no, that's perfect. And I came in the business in like 2011, but I really didn't start to like get traction until like maybe 2013. But I remember like when we would go for hard money, it was like minimum 15%. If you're an experienced borrower, like 15% at 3 points, that's like the experience level. And they weren't going to 90 of the purchase price and 100% of the renovation. Some of them wouldn't even fund the renovation, or they would fund it like 80% of it, so it's changed so much since Wall Street and the institutional capital has come into our space. And it's in my opinion, it's made it better, right? And I think it's like what John was saying is like on stage, that liquidity is like air for your business, right? Like and right now liquidity is a very hot topic. So what do you see going on right now with the economic environment that we're kind of in, especially the private lending space, because it's been very volatile and kind of bloody, right? There's been some casualties. So what's your thoughts on the private lending industry now?
Yeah, so to speak mainly to the institutional capital, because that's where you've seen the most change, is the money's still there. It's just they're demanding higher rates now, and it's not the lender's fault. It's really where the cost of capital is. So like I said, the money's still there. It's just you're going to see higher rates. They're going to start going, or they've already started to go up. They're probably going to go up even more with the Fed increasing the rates over the next few months. And that's just the reality of it. So I think the institutional capital is going to go up first, and then all the other lenders that have other sources of capital, they're going to eventually they're eventually going to increase to where the normal is probably going to be. It's hard to say, but maybe it goes back up to the 12% range. Maybe it's lower. Maybe there's still going to be a variation of institutional capital's higher than the non-institutional capital. So it's really in flux right now, and I think it's going to take another 6 months for it to really stabilize and figure out how we move forward, because things are still really changing on a monthly basis.
Yeah, totally. And so how do you stay so up to date, Rocky? Is it because we're constantly adjusting the guidelines on the website too? Actually, we probably should adjust ours. We got to adjust ours on yours too.
Yeah, I haven't bugged you about that, but yeah, a lot of lenders have not updated it. Most of them have. So that's how I stay up to date on that. I talk to lenders frequently and see what's happening in their world. And I go to every private lending conference, and there's a lot of them. There's probably one a month, and I get to talk to lenders in person there. So yeah, that's really how I stay updated.
Rocky, what would you say is one of maybe the top 2 or 3 things that investors should keep in mind as we go into the next 12 months? Well,
just know that pricing is going to continue to to move. And in the long-term rental space, what's happened in the last few weeks now is that those prices or those rates have come down a little bit. So it's just, you just have to realize that the pricing that you're quoted is not necessarily going to be the pricing that you close at, and you just have to be open about that. And obviously it could kill your deal, but it's just hard to control right now. There's really nothing you can do about it until the Fed is done raising interest rates. Everything's just going to be a little tough with in terms of really determining what your pricing is going to be. And like I said, it's not the lender's fault. They're really they're really relying on their cost of capital, and the cost of capital has gone up by 2 or 3% in the last few months.
Yeah. This is great info. And actually, can you tell us, Rocky, right now about how the money usually flows, right? Sometimes you might have you have the originator, right, which is primarily where the space that we play in, the originator, and then you have the lender, and then you have the lender's investors, right? Like can you map the ecosystem for us?
Sure. So
Like
again,
the basic one, like the usual. I know there's many, that's why. So
yeah. So again, it's separating the institutional from the non-institutional. So in the institutional world, which is what's funding most of the deals that happen today throughout the country, is the originator, which could also be a lender. Sometimes the originator is a broker, but let's just say it's a lender. So they're dealing with the borrower, they're providing the quotes, they're funding the deal. Usually they use their own money to fund the deal, and then they sell it to a loan aggregator, is typically what they're called. And there's not that many of these aggregators. There's probably 10 to 20 of them in the country, and they buy all of these hard money loans from the lenders, and then they package them up, and then they sell them or securitize them to Wall Street, where and each step along the way, each person has to make a profit. So let's say the interest rate's 10%. The lender that funds your loan has to make at least 1 or 2%. So they're selling the loan for 8%. Then the aggregator has to make a profit. So they're packaging these loans and offering a bond, and then maybe they're selling it at 7 or 6. So each step along the way, there has to be a little bit of profit for everyone. And at the end, in the institutional world, it ends up where it's in this package of loan, and there's it's really a bond, and then they have a minimum requirement of, right now it's, let's say, around 7%. So that's really how the money flows in the institutional world. And there is still a lot of this capital available. So usually when they securitize the loans, they're offering a bucket of, let's say, $200 million worth of loans. Sometimes it's more. So that's the institutional capital world. Non-institutional, typically it's let's say a fund manager. They've raised a fund, and they've got let's say $50 million that they're of loans that they have in their portfolio. So there it's a bit more straightforward. The investors in the fund, it could be, let's say they have 100 investors that have pooled their money into this fund. They get a monthly return on it, and then all the money stays in the fund. They don't have to sell the loans. It's a pretty clean structure, but it takes a lot of time and effort to raise the capital and grow that fund. And all the investors in the fund, it's very passive income. So they might be putting in 100,000, they could be putting in $1 million. And the fund manager just has to grow the fund, but the fund manager makes all the decisions as to what to lend and what deals to close, and the investors in the fund don't have any say in it. So they have a bit more flexibility. They're still going to be conservative in a lot of cases, but that's how it works in a fund. And then the third model is an originator or a lender that they may not use their own money. They might have an individual investor who's not experienced with mortgage investing, and the lender pitches a deal to them and says, "Hey, I've got this deal. Are you willing to fund it?" And then if the investor takes it, then when your loan closes, they're pretty much that investor's wiring the money at closing. The lender takes the points, and then the investor takes the interest. In some cases, the lender might take 1% out of the interest. So if they're selling the loan to you at or not selling, if they're funding your loan at 10%, the investor of that loan might be making 9%, and then the lender's making 1%. But the lender's still involved, and they have to make sure you make your payments, and that's called servicing. So so that's another structure that's fairly common. That's a very common structure in California. And again, prior to institutional capital, that was always a very common business model. It's just it's hard to scale, you know, with that, you know, because you're dealing with so many individuals. It's really difficult to manage them and figure out who wants what and who's willing to fund what deal.
Yeah,
but that's the third model.
Yeah, because like that's how our fund is designed, and actually we probably still will be, you know, but we're very careful with that, because for that reason, the moment you take a penny, you know, like then now you're subject to that, you know, those your fund guidelines, your investors in the fund, right? So it is, and that's why we're so new to the space that we're still learning a lot, and that we only had the capacity to learn the one side, the origination side, right? And so, but learning like the management of all the investors, I mean, I think that we can probably learn pretty quickly. We kind of do it already, you know, we just need the right, you know, technology. But I think what you're saying too is like there are some lenders out there that are structured differently, so that in times like this, when a lot of the institutional lenders had to pause lending for a little while, you know, even a couple of years ago during COVID, because, you know, there's a lot of things happening with their capital. The guys who had funds, like Rich Katz, you know, he's might be the only guy I know that's playing on the national level that is like kind of formed like that. I mean, I'm sure there's a lot more other guys that I don't know of, but to me, like, because he has that type of capital that he's managing at that level, you know, in the billions. But when times like these happen, like everybody's calling him, you know, because usually he's more expensive, a lot more conservative too, right? Because he keeps it on his books, right? So it's all got to make every decision on behalf of his investors, which I have a lot of respect for Rich. But what do you see in the near future, I guess, of where the space is going? Are hard money rates should we expect them to be high until maybe a certain, you know, year or quarter, and the leverage is lower, or do you see it stabilizing? What's your thoughts?
I don't think it's going to stabilize until next year, but I see the institutional capital rates going up even more. Right now, it looks like they're starting at 9.5 to 10%, and then they can go as high as 13% as of right now. And everyone's expecting the Fed to increase the rates again in next month, and then possibly before the end of the year as well. So that could cause the rates to go up even more. So I would guess they're going to be between 11 and 13%, or 11 and 14% for most of the institutional capital. Now, with the non-institutional capital, they're not forced to raise their rates because they're not relying on the Fed rate, or what they call the prime rate. But they will eventually have to increase, because the investors in the fund are going to be getting higher yields from other investments. So they're going to go to their fund manager and say, hey, you know, whatever you're paying me right now, 7% or whatever, is not enough. I want more. Otherwise, I'm taking my money somewhere else. So they're eventually going to increase their rates. The individual investors who will fund a single note, they might do the same, where they'll demand higher rates because everything's going up. So just expect that everything's going to keep going up. When, you know, in the future, if let's say the Fed, if they reduce the interest rates overall, maybe later on at the end of next year or the year after that, once they come down on their rates, then all the institutional lenders will be able to reduce their rates. And I think the private lending firms that fund these loans that are being sold to the secondary market, the institutional guys, they want their rates to be competitive. They're not going to keep them high just because everyone's already used to it. As soon as they can reduce rates, they will, because they want to do more deals, and they want to beat out their competitors on pricing. So as soon as it's possible to reduce the rates, they will. But I think it's going to take a lot of time.
Yeah. And that was kind of the atmosphere in Miami. Was it's like, man, like companies are catching a lot of heat, from clients and stuff, but like it seemed like the sticker shock period kind of blew over a little quicker, for us anyways, than we expected. When COVID happened, that was a hard one, because it was so fast and quick that nobody had a time to adjust. Even this time, it was pretty hard to adjust still. But and it's still not adjusted, like you said. If Powell comes out next month and like another big interest rate hike, and everybody's got to make their move, we're gonna feel it. But I think the point is, which is important for everyone on our call, because primarily we're borrowers, is that, look, you're hearing it from Rocky, who like is probably one of the best to be asking questions, right? That's why we'll open up the room next for questions. But he's telling us that he expects more rate hikes. It's not going to go down anytime soon. So what does that tell us? We gotta to change our criteria on the front end. Start maybe adding longer days on market, because you might be playing in a buyer's market now. But either way, we should be adjusting the numbers to absorb those extra costs, so that you don't feel it on the back end, and get stung on the back end, right? So I think that's important information to know. And we have to remember that, in my opinion, especially in high dollar markets like Hawaii and Seattle, and if you're doing bridge loans, you're getting bridge loans, fix and flip, or ground up construction, the price doesn't matter. It's the leverage. It's the leverage and how the leverage is allocated. At some point, the price is going to be too much, right? But if you're baking it in on the front, right, and you're being ultra conservative, and you can still compete for deals, then it's not about the price. It's about how the leverage, so that your ROI can go higher, right? And so, does anybody have any questions for Rocky before we keep going? Let me check the chat too. Thank you, Rocky, again, for that info. It's great information. Check out Rocky's YouTube channel, because like I learned so much from there, from your channel.
Hey, Rocky, what are the couple of websites or podcasts that you listen to right now that you're finding as the best resources to keep current on what's happening and all the changes?
Yeah, good question. So one of my favorite podcasts is Lender Lounge with Kevin Kim, but you guys are probably not going to find that interesting, because it's so specific to lending that it's probably just too much information, and it's going to be kind of boring for you. But other than that, I just started listening to a couple of the bigger podcasts ones. So Bigger Podcasts. I'm sorry, Bigger Pockets podcast. Bigger Pockets has probably 5 different podcasts, and one of them is money, and then they've got another one. I don't know. I only just started listening to the money one, so that's pretty interesting so far. And then there's this lender called Lima One Capital out of South Carolina, and this guy Dalton Elliott from that company runs a podcast, and that one's a bit more broad. It covers some lending, but it's mainly focused on investing. So that one I think you guys would find interesting, because it mixes in both of them.
I love Dalton too. He's great.
Yeah.
And Jeff Tennessee, on our last call, I was sharing kind of his words that he had on Thursday about the space and the times with our group, and it was great, man. I loved it. I was sidebar chatting with him. I was like, dude, thank you. That was great. And I took away a lot from him. I mean, he's a seasoned CEO, right? And he manages a large company in Lima One. Does he still own that, or is he now? Did he sell his position?
Well, so he's still the CEO, but Lima One was sold to MFA Financial, which it's interesting. So Lima One Capital, kind of going back to what we were talking about earlier, as far as lenders selling their loans. Lima One, at their size, they were selling loans to multiple companies, and then this firm MFA Financial, which is a private equity, I guess they're a hedge fund as well. They were buying a lot of loans from Lima One Capital, and it worked out really well for them. They liked the investment, so they acquired Lima One because they didn't want them to sell their loans to other people. So that's how that happened. But yeah,
he sold 100%.
I think they did sell 100%. Yeah.
Wow. Oh man, I'm happy for him.
Yeah.
Like that's the dream, maybe to never sell, but just to have someone interested in buying what you've created.
Sure.
Right. So, and what is the biggest acquisition that was public to your knowledge? Do you know?
In private lending, the biggest one was Anchor Loans. So Anchor is a company out of LA, and they started in, I think it was the late 80s. So they had a head start, and even though they weren't institutional initially, they became institutional as they scaled. So they were sold to a company called Pretium for 1.5 billion.
Wow.
So
Okay.
Pretium is one of these institutional property owners. So they own a ton of rental properties throughout the country, and that's their biggest business. But they wanted Anchor Loans to help finance those deals, and Anchor just built a really good business. I know the CEO, or he's the ex-CEO now, and he was part of the California Mortgage Association. So I spent a bunch of time with him there, and he built a really impressive business. And Anchor is kind of, they're kind of the silent one in our industry. They don't advertise a ton. They've just built up a lot of relationships with their real estate investors over the years, and never really advertised a whole lot. So a lot of people don't even know about them.
Yeah. That was the first time I met the CEO, which was I think, was his name Mike? I think he was the, who is it?
You mean on the last NPLA meeting?
Yeah.
Oh, so that's the new CEO, Andrew Pollock. So the old CEO was Steve Pollock. I don't know if they're related, but yeah, Steve Pollock stepped down when he sold the company.
Got it. Yeah, I'm sure they're, yeah. Well, yeah, so that was the first time I met Andrew. He did the what is it called, facilitating for the panel that we had, and he was great to work with, honestly, for the short time that I got to work with him. But so that surprises me that they sold for 1.5 billion, because I didn't know that kind of value could hold in our space. But because isn't it all bridge loans? So it's not really assets on the books unless they held it on the books, right? Or did they have rental properties and DSCR or loans that they were holding? Or
I think the valuation is not necessarily them holding the loans. It's just the machine that they built to be able to fund that many loans and then sell them and still make that much of a profit. So it's more about the business operation and the relationships they have, because that's really what takes so much time to build in the lending business. The capital is always there, right? You can always figure out where to sell your loans or how to get investors, but it's really about having that brand and your real estate investor clients and just the operation of the business.
that's really good to hear from you, actually, because when 5 Arch sold, I think they sold for 50 million, right?
Right.
To Redwood or something? Yeah. And when that happened, I mean, it was chaos. Like I had a bunch of loans with 5 Arch, and like I was on the phone with them every day. They didn't know if I was getting my draws, like it wasn't a good transition, but they ended up getting absorbed, right, when they acquired Corvest too. But I was surprised, and I was talking to my guy Spencer, who was working with 5 Arch at the time. I said, Spencer, how come they sold for only 50 million? I would have figured at least 9 figures, and he said because they're primarily a bridge lender, instead of like they don't have any assets on the books when it came to like maybe holding any loans on the books, I guess. They sold everything, right? So I guess, but you're saying that it was more the brand, the volume maybe, and the relationship. So that's good to hear, because I always thought that is the value, in what we do. And it's not necessarily like how much loans you have on your books and stuff performing. So that's actually, encouraging to hear. Kelly's got a question. Kelly.
Hey, brother Rocky, aloha. Mahalo so much for being here, dropping some nuggets, bombs, and coconuts and pineapples. So appreciate you, brother.
Sure.
My question is for the DSCR loans. Are you seeing out there like a lot of maybe investors or even lender side closing doors or not taking as much DSCR loans? Is there like a percentage you've seen? And then also, would you recommend, I guess, to investors, hey, try to pump your brakes on the DSCR loan right now, just focus on maybe other strategies until it gets better? Or no, is it still fine? Just go full board with the BRRRR strategy and DSCR loans. So what is your take on the market out there for DSCR loans?
Sure. So the DSCR loans are still around. There's still plenty of lenders that are funding them. The rates have been, as of, let's say, a few weeks ago, were in the 7 to 9% range, or maybe 7 to 8.5. Now they've gone down to just a little bit. So you could probably find some lenders funding them at 6.5%. But there's still capital for it. So it's just a matter of the numbers making sense. If you can, if you can still qualify, or if the numbers don't make sense, you just have to put more money in the deal. And there's nothing else you could do about it. But yeah, it's still around, and there's still lenders doing it. What's going to happen soon, and I've already seen it a little bit, is you're going to see some lenders offering an adjustable rate. And this is just another creative way for them to make this work. And that's where you see the rates come lower. So if you start seeing lenders advertising at a rate of 4 or 5%, that's probably because it's adjustable, and they're probably doing a 6-month adjustable or a 1-year adjustable, which is very risky. But yeah, otherwise for the 30-year fixed rate, it's going to be a minimum of 6.5.
Yeah, I think I've seen, I guess other lenders was even doing bridge for like 24 months, maybe, to be able to help the investor. Yeah, you're right. People getting creative, or doing an interest only 5-arm. And then, yeah, as far as to be able to make the DSCR work for the, I guess the loans. Yeah.
Yeah. Cool. And like you mentioned, there are some of the even the institutional back lenders are going to start getting more creative, where they're thinking about a bridge to the, bridge after the bridge. So if let's say your deal doesn't qualify for a DSCR loan, they might offer a 2-year loan after the first year of the, let's say, the rehab loan, and that'll just get you through to the time, and hopefully rates come down where you can, you could do a DSCR loan for a 30-year fix. So yeah, I think we're going to see some more creative structures that come out in the next year or 6 months.
Nice, great question. That was great insight. Does anyone else have any other questions while we have Rocky? Like, this is perfect timing, especially because it's kind of crazy out there right now. It's almost taboo to say DSCR now, when like maybe 6 months ago, or like, like beginning of the year, it was like all the rave.
Hey Rocky, this is Joel. This is Joel Banco. How you doing?
Hey,
Thanks
good.
for all the awesome information. Hey, really quick. I was just looking on your website, and I was just specifically looking here in Hawaii. So looks like you've had 3 transactions, 2 in Maui and the other here on Honolulu. Are there more, or are those the 3 that you folks have?
So the transactions that you see on the website are not ones that we've been involved in. Really, what that page is it's just a section of the website that any lender can use to promote some of the deals they funded, just kind of like example deals. So first of all, that's why it's limited. And I really try to get more lenders to use that. It's just been tough because, they have to, they have to upload that information. They have to type out a summary of the deal, and most people don't take advantage of that. So
We'll take advantage.
Yeah.
Yeah, we gotta. Okay, Layla, we gotta do that.
And I'm rebuilding that whole section now. So in the next 3 weeks or so, it'll be totally different. And I think a lot more lenders will use it.
Yes.
But there are not that many lenders that are bullish on funding loans in Hawaii. There's a bunch that say they will. But that's obviously, I'm sure you guys know, it's a bit limited.
Yeah.
Awesome. Thanks.
And what's funny is the position we're in, and we're just describing this like we already knocked on the doors, and so we kind of already have that lined up, right? If somebody goes direct to, let's say, a large institution like Civic or another, or Anchor or something like that, if their deal gets shut down, they got to go knock doors. It's like, but if you go to a lender, that's why it's good to know where your lender is in the ecosystem, right? Are they a direct lender? Because there's a lot of pluses to going to a direct lender, but there's also some pluses that come with going to maybe originator or correspondent like us, where we've knocked the doors, we've established those relationships, and then we can be the conduit, right? So there's a give and take on both sides, I think, in benefits, but there was a lot of disruption, and I'm glad you brought that up, because in what we've been seeing is that some lenders will be saying like, yes, we're lending, and then they get left at the table because they're lending, but not really, like maybe they're lending to existing clients and they're focusing on their attention on that, or maybe their bank is holding them to a certain amount of loans that they can give exceptions for, and yours just missed the cut. So your exception does not get passed. Sorry, your deal is not going to go through. Now you got to go knock on all the other doors, or just go to Rocky's site and just go to Rocky's site, plug in what you need, and then you'll find your best ones, right? So that's the positions kind of that we're in. Like Rocky's knocked all the doors, and he's continuing to knock the doors, right? Like going to the conferences, building those relationships, getting them on the platform, getting them to fill out their profile as specific as they can, so that when somebody searches, like, they're put with in the right hands. So use Rocky and his resource and his experience. Does anyone else have any other questions for Rocky or for private lending in general? I know there's a lot of us on the call that have millions of dollars in debt to these guys. Okay, so you can ask the hard questions.
And if you think of anything later, I'll put my email here so you can send me an email directly later on.
That's awesome. Thank you, Rocky.
Yeah, of course. I'll put it in here right now.
All right, guys. Well, thanks. Yep. Perfect. And again, I can't say enough, like, check out Rocky's YouTube channel. But Rocky, thank you so much for coming on, being our guest. It's been an honor to serve with you in the NPLA too. And I'm really excited actually for the years to come, because I see the space changing, and there's great people spearheading the way like yourself. So Keiko, you have any questions or final words for Rocky? You're muted.
I am muted. Here, I've been talking the whole time.
Sorry, that was me.
No, that's good. No, thanks, Rocky. Always good to see you. Always great to hang out with you at the events, and
Of course.
and you got such great experiences. So your email address is there, so we can touch base with you with any questions. And if you ever have time on a Friday and you want to just jump in and give any updates as to what you're seeing in the market, we're here every Friday afternoon. And even if you're available for 5 minutes, we'd love any insights.
Yeah, appreciate that. And I was just going to say, as the interest rate environment's changing, I'll put out more YouTube videos. Like I'm going to put out one next week about the DSCR interest rates, but I'll do one every quarter until things stabilize. But in addition to that, I'm happy to jump on, to give you guys an update personally. It might not, there may not be anything interesting to say for the next, 2 months or whenever it happens. We could always check in, and glad to jump on and give you guys an update.
That would be awesome. Thank you so much, Rocky, thank you.
Yeah, of course. Thank you for having me.
Yeah.
Thank you guys for jumping on another Friday call. Hope you guys all have a great weekend. Happy Aloha Friday and aloha.
Aloha.
Aloha.